Hi, and welcome to this morning's early, concise highlight. It is currently 6:30 a.m. on Friday, January 15th, coming a bit earlier than usual because we wanted to make sure this is posted up prior to the release of U.S. retail sales along with a bunch of other data. We'll get back to that in a moment, but the real driver this morning is the extended weakness of crude oil, slipping back below $30 a barrel. And what has this actually meant to the market, and especially we have to say what has the continued weakness of oil and commodities meant? Well, the S&P 500 future is off $30 at 1884. So we're getting back down toward the lows from yesterday, essentially, compared to where we rallied to. And, of course, that trading low was down here at 1872, but the bigger lower support is down into the 1865 to 60 area. And we'll be revisiting that on the monthly chart once again, why that's so important. But you can see it was an old trading low from which this Fibonacci level was derived on the March contract as well. Now, the interesting part of yesterday was getting near this 1865 to 60, not quite there, and the market started reversing up on, in fact, a near-term recovery in the oil price helped spur this, along with, once again, the Bank of England holding steady, so it took some pressure off, but it's interesting where the market went back to. As you know, ever since it failed the 1975 to 70 support, a week ago Thursday, this gap lower, and we had been clear unless it can get up to and clean up above at least the trading low at 1971.50, which it failed to do. It was not closing off the gap, and gapping below that area, it reinforced the tendency for greater volatility on the downside, where the market in any event tended to knock out support at 1960 and the other interim support at 1930 on its way down to 1900 or lower on previous sell-offs. You know, this goes back to even earlier times, but especially August and September of last year. And lo and behold, that's exactly what we got. Test of 1900, failing on attempts to stay back above the upbreak at 1926.5. The 1930 area left it back under pressure below 1900 on Wednesday, and then recovering yesterday. But look at where it bounced back to. Once again, on the theory of the key levels being the places these markets will move between in a volatile fashion when they're volatile, this is pretty much a clear indication of that. It was able to get all the way back up toward the 1925 area and then ended up still failing late yesterday, and now spilling over into today, right back below 1900 toward the bigger support. So that's going to be very interesting, and that really pretty much does it for the short-term view of the S&P 500. If it should break 1865 to 60, the next supports aren't until down around levels at 1830 to 1813. That was the big October 2014 Ebola scare low. Important to take the longer-term view when these things get so volatile, and that is the major upward channel since the low down at 666 back in March of 2009, the overall cyclical downturn low out of 2007 into the crisis in 2008, spilling over into early 2009. And quite a few people have asked, well, why aren't you just extending this trend line across the low from 1068 back in October of 2011, another important low, and that is because subsequent to that, that trend line's parallel topping line was up in here. The market had accelerated through the top of that. At that point, we used the reference line that is the actual highs on the upside to tell us where the idealized parallel support is on the downside. That's why this line in space is so important. And this month, it is actually right at the 1865 level or so. and the Fibonacci support is right there. So we're using 1865 to 60 as the major support. Again, there is some support below it into the low 1800s, and even some further Fibonacci and old upside acceleration support even as low as down here into the 1770s. But make no mistake, any failure below 1865 to 60 by any degree is at least a preliminary down break and must be respected in the near term. If it manages to hold, then that would be grounds to think you could rally back up to something like 1975 to 70, or even back up to the down break in the 2015 area. So we'll just have to see what happens with energy and commodities, in all likelihood as a driver for this market.